Hi, everybody, and welcome back to Chapter 3 Alpha, the appendix for Chapter 3. And here we're going to take a look at job order costing, a Microsoft Excel-based approach. Okay, so here we use Microsoft Excel to summarize the flow of costs in a job order costing system. And of course, you know the balance sheet equation where we have assets equal to liabilities plus stockholders' equity. And the computation of ending balance and retained earnings is part of stockholders' equity. And that's an easy one. We start with beginning retained earnings. We add our net operating income and subtract dividends to get the ending retained earnings balance. So here are our three key assumptions. Number one, we will always use only one predetermined overhead rate. Number two, any underapplied or overapplied manufacturing overhead will always be closed to cost of goods sold as reported in the income statement. And that's normally what we would do in the real world anyway. And then number three, we'll record transactions within Microsoft Excel by using positive numbers to increase balance sheet accounts and negative numbers shown in parentheses to decrease balance sheet accounts. All right, let's take a look at an example here for the Sapphire Company. The transaction template that we'll use to record the company's transactions is shown as a spreadsheet. It reflects the beginning balance sheet account balances, all of the accounts shown in the beginning balance sheet, plus an account called manufacturing overhead. So we consider manufacturing overhead a clearing account that will always have a beginning and ending balance of zero. This account, number two, is used to record two things. Alpha, all actual overhead costs. Those are the debits. And then Bravo, the amount of manufacturing overhead applied to production using the predetermined overhead rate. That's the credit. There's always going to be a difference between actual and applied. So that difference, number three, between actual overhead cost and the amount of overhead applied to production is called underapplied or overhead or overapplied overhead, as the case may be. Okay, so to begin the illustration, let's assume that the Sapphire Company has a predetermined overhead rate of $25 per direct labor hour. That was based on a cost formula that estimated $100,000 in manufacturing overhead cost for an estimated allocation base of 4,000 direct labor hours. During January, the company completed the following actual transactions. Alpha, it purchased raw materials on account for $80,000. Bravo, raw materials used in production, $78,000. $70,000 was direct materials, $88,000 was indirect materials. And then for Charlie, we paid $135,000 of salaries and wages in cash. $68,000 of that was direct labor, $45,000 was indirect labor, and $22,000 was related to employees responsible for selling and administration, sometimes called SG&A, sales, general, and administrative. Okay, so additional transactions. We had some utility costs that we've incurred on account to support production of $15,000. Echo, depreciation recorded on property, plant, and equipment was $40,000. 70% was related to manufacturing equipment, and 30% related to assets that support selling and administration. For Foxtrot, advertising expenses paid in cash was $18,000. And for Golf, prepaid insurance expired during the month. $1,000 or 80% related to production and 20% related to selling and administration. For Hotel, manufacturing overhead applied to production was $102,500. That amount was computed by multiplying 4,100 direct labor hours worked actually in January by the predetermined overhead rate of $25 per direct labor hour. For India, cost of goods manufactured was $235,000. For Juliet, cash sales were $320,000. Kilo, cost of goods sold was $245,000. Lima, cash payments to creditors was $92,000. Mike, we closed over-applied overhead of $5,700 to cost of goods sold. So let's set up our initial Excel spreadsheet showing beginning balances. And here it is. The completed transaction template is shown as a spreadsheet. It reflects the ending balance sheet account balances. So here's cash. Here's what we paid for our salaries and wages. We paid for advertising. Sales, we had cash in from the cash we received. And then $92,000 that we paid to our creditors. So our ending balance was $90,000. We did that for all the accounts here. Raw materials, $10,000. Work in process inventory, $10,500. Finished goods, $3,000. And finished goods, of course, is comprised of the cost of goods manufactured that we transferred in from work in process inventory. You can see that it came out of work in process inventory here. And it also has had a $13,000 beginning balance. So our cost of goods sold was $245,000. And so that left us an ending balance in finished goods inventory of $3,000. Okay. Next, we had prepaid, or I should say manufacturing overhead account. So here are all our actuals. We had raw materials used, salaries and wages, utilities, depreciation, expiration of prepaid insurance, but then we applied $102,500 to jobs. That did not quite balance, so we had over-applied overhead of $5,700, and we charged that to a manufacturing overhead, with the other being to cost of goods sold on the income statement. Now our prepaid expenses, we had the same kind of thing here. Property, plant, and equipment net of depreciation. We had $240,000 beginning. We had an additional $40,000 of depreciation. So that took our ending balance down to $200,000. Then accounts payable. This was all the assets. Now the liabilities on accounts payable were shown here. Okay, and so this accounts payable, of course, and then retained earnings. Started with beginning retained earnings. And we subtracted out all our expenses here, including cost of goods sold. And we added in our sales, $320,000. We also added in the over-applied overhead, which came over from the income statement to retained earnings, as did these expenses when we did our closing entries. Okay, that reflected the ending balance on our balance sheet. And of course, the assets equal liabilities plus stockholders' equity. All right, so let's look at this in a little more depth. The explanation of transactions during the period. For Alpha, we debited raw materials and credited accounts payable. Pretty straightforward journal entry there. For manufacturing overhead, for indirect materials, we brought that in. Indirect materials is an overhead account. We're going to bring that into the actual side, a debit, and we're going to debit work in process for that which we transferred to jobs. And that the credit then would be to raw materials inventory for $78,000, which we reduced our raw materials inventory and increased our work in process inventory for that reduction from raw materials inventory. All right, so then for Charlie, we had a debit to work in process for $68,000. That then includes our manufacturing overhead for $45,000, the salaries and wages expense for $22,000, and we also credited cash for $135,000. That was our debit to work in process for the jobs that we incurred during that period. Then we're going to debit for actuals under Delta here, our manufacturing overhead for $15,000 and credit accounts payable for that same amount. For Echo, we're going to debit another $28,000 to manufacturing overhead for our other manufacturing overhead items that do not include indirect materials or indirect labor and those charged to jobs. So here, this is going into our overhead account for the depreciation expense and the credit of $40,000 to accumulated depreciation, property, plant, and equipment. Now, for Foxtrot, we're going to debit advertising expense for $18,000 and credit cash for the same amount. Easy journal entry there. For Golf, we'll debit manufacturing overhead for $800, selling and administrative expenses for $200, and credit prepaid insurance for that full $1,000. All right. So now we're going to debit our work in process and credit manufacturing overhead. Now we'll get into what we applied. So here we're going to increase our work in process inventory by another $102,500 for that we apply on the credit side of the manufacturing overhead account. Then for India, we're going to debit finished goods inventory and credit work in process inventory for $235,000. All right, that's our cost of goods manufactured. That's what we actually transferred into finished goods. And then for Juliet, we're going to debit cash and credit sales revenue for that which we sold. For Kilo, we'll debit cost of goods sold and credit finished goods for that same amount that we sold. And then for Lima, we'll debit accounts payable and credit cash for $92,000. And for Mike, we debit manufacturing overhead and credit cost of goods sold for the over-applied overhead of $5,700. That looks like a good place for us to stop this video. And when we return, we'll take a look at the next portion of this slide. Until that time, Bye for now.